Welcome to Lesson 10, the final class in T0 Investing Foundations. Today's topic is risk management, how to stop losing money. You'll learn why losses hurt more than gains help / setting a safety line with the 1 to 2% rule / how to size a position / automating your stops / 3 survival rules. Even if you nail the other 9 lessons, without risk management, a rough market can wipe out a big chunk of your capital. This is the last step that protects the money you need to stay in the market for a lifetime. Ready to begin? Losses are much harder to recover than gains. That principle is called asymmetry. Concrete example, start with a $10,000 account and lose 50%, you're left with $5,000. To get back to $10,000, you need a 100% to gain.
Lose only 10% and you need about 11.1% to recover. Lose 5% and roughly 5.3% gets you whole.
The bigger the drawdown, the steeper the climb back.
A 20% loss needs A 25% gain, 30% needs 43%, 50% needs 100%.
Run the numbers yourself. After the 1929 crash, the 2008 financial crisis, and the 2020 COVID shock, the investors who lasted weren't always the ones chasing the highest returns. They were the ones who limited losses first. That's what not losing is how you win really means. Research also shows that for long-term investors, cutting losses is one of the strongest drivers of compound growth. Here's the core live trading rule. Decide in advance that the most you can lose on a single trade is 1 to 2% of your whole account. Concrete example, with a $10,000 account, that means risking at most $1 to $200 per trade. With a $1,000 account, that's $10 to $20. Do that, and even 10 losers in a row only cost you 10 to 20% of the account, enough capital left to keep trading. Check it against your own equity curve. If your stop is 5% wide and you want to keep the dollar loss at 200, you buy about $4,000 worth. A wider stop means a smaller size. That's position sizing. We'll do the math next. At first, the rule feels tight. You think, how am I ever going to grow like this? But after 3 to 6 months of live trading, many investors finally see how powerfully it protects their capital. Position sizing is how you turn the 1 to 2% rule into actual numbers, deciding how much to buy or sell with math, not vibes. The formula is simple. Account times allowed loss quotient divided by stop width equals how much you can buy.
example, $10,000 어카운트, 1% 리스크, 5% 스톱 그러면 $만 곱하기 사인 1%, 나누기 사인 5% $2,000 was. Another $5,000 어카운트, 2% 리스크, 10% 스톱 그러면 $5,000 곱하기 사인 2%, 나누기 사인 10% $1,000 was.
Try the math yourself. If you size by gut feel, the actual loss often won't match the stop you planned, and a much bigger hit becomes likely. Position sizing isn't flashy, but it's the most reliable way to protect your capital in live markets. This formula is the bridge between foundations and real trading. Stops are hard to execute because of emotion. If I just wait a little longer, it'll come back. That voice is what turns small losses into big ones. The fix is stop automation. The moment you buy, place a stop order. Leave no room for feelings to negotiate. Example, buy Bitcoin at $100,000 and pre-register a stop at $95,000. When price hits it, your broker sells automatically, even if you're away from the screen. You don't have to babysit the chart, and emotion can't override the rule. That's the real value of automating stops. A stop isn't a signal that I was wrong. It's a signal that I managed the loss as planned. Shift that mindset, and the next trade stays calmer too. Risk management really comes down to 3 rules: diversification, position sizing, and stops. Keep these 3, and you survive most market shocks. Diversification. Don't pour everything into one asset. Spread across stocks. Think S&P 500 or not. Bonds and commodities, or even within crypto, split spot, futures, and time frames so one downtrend doesn't sink the whole account. Position sizing. Size each trade so you risk only 1 to 2%, building a structure that can absorb 10 losers in a row. Stops. Sell automatically at a price you set in advance, cutting emotion out and locking in the planned loss. The more firmly you keep these 3, the better you weather uncertainty. In the 2008 crisis and the 2020 COVID shock, people who followed them survived. Flashy analysis is secondary. Survival comes first. You've finished all 10 lessons of T0 Investing Foundations. Seriously, well done. The 10 ideas from T0: the value of money, the power of compounding, types of assets, how markets are structured, stock basics, bonds and rates, understanding ETFs, tax planning, how orders work, managing losses. That's the basic language of investing. On top of that foundation, you still need your own principles if you want to last. Don't just copy others. Keep asking why, and check that you actually learned it. From T1 onward, we'll learn how to read charts, candles, support and resistance, moving averages, volume, and indicators, step by step. With T0's vocabulary, charts get a lot clearer. If this helped, please subscribe and leave a like. This course is for education only and is not investment advice. Every investment decision and its outcome is your own responsibility.